Good morning, everyone. Let's go ahead and get the meeting called to order. Item number 2 on our agenda this morning is to approve the minutes of the meeting of August 8th, 2019. I have a motion and a second on item 2. All in favor? Aye. All opposed? Motion carries. Item 3 is a consent docket. We have one item. I have a motion and a second on item 3A. All in favor? Aye. All opposed? Motion carries. Item 4 is to ratify approvals. We have 4 items. Motion and a second on item 4. All in favor? Aye. All opposed? Motion carries. Item 5 is to approve the claims docket. Have a motion and a second on item 5. All in favor? Aye. All opposed? Motion carries. Item 6 is to approve the following applications for service retirements. We have 7 applications this month. I have a motion and a second on item 6. All in favor? Aye. All opposed? Motion carries. Item 7 is to receive the report of death, authorize payment of the $5,000 death benefit, and approve continuation of the pension to spouse. 3 cases. I have a motion and a second on item 7. All in favor? Aye. All opposed? Motion carries. Item 8 is to receive the report of death, authorize payment of the $5,000 death benefit, and authorize the Secretary to make necessary changes to conform on the following. I have a motion and a second on item 8. All in favor? Aye. All opposed? Motion carries. Item 9 is items for individual consideration. Item 9A is consider eliminating the commodities allocation and increasing the real estate allocation targets in the investment policy objectives and guidelines. Jason, you want to speak to us a little bit about this one?
Sure. I think you have an asset allocation analysis that was sent out previously in your packet. So this is something that we've been revisiting this year. I think I mentioned to you the last meeting as we revisit our capital market assumptions from year to year. One of the big changes this year was that our long-term inflation assumption came down by quite a bit. As we look at, in the past, all we've done is look at historical long-term inflation and use that as the inflation factor. But being a little bit more thoughtful and forward-looking, thinking about global demographics and an aging population and developed economies, U.S., Asia, the advancement of technology, really expecting long-term inflation to be lower than what we've seen historically. And that has had an impact on our commodity assumption, where inflation was a big component of that commodity assumption. So if you look on page 1, the capital market assumptions, you'll see that the commodities return assumption, both intermediate and long-term, is now around 2 to 2.75%, with a volatility still of 18%, really high volatility, which that hasn't changed. So effectively, as a strategic allocation, any inclusion of commodities in a strategic allocation isn't improving risk return of the portfolio from a modeling standpoint. That's not to say that commodities couldn't be beneficial from a trading standpoint, being more tactical, where there's maybe opportunities to go in and out of commodities, but in our view, it's difficult to include it in a strategic static allocation. It just doesn't make a lot of sense here. That said, you also continue to have inflation protection in your portfolio via equities, as well as within the equity managers, they're investing in natural resources and energy securities, as well as real estate as a big inflation component. So if you look at page 2, where we did the modeling, the first column that says target, that's your current target allocation in your investment policy. So 25% broadly to fixed income, 60% broadly to equity, and 15% broadly to real assets. And then underneath that, you see the breakdown of the different components that is in your policy. So on the real asset side, currently it's that 15% allocation is 6% to core real estate, which is the Morgan Stanley piece, 4% to opportunistic real estate, which right now is just, it's barely one, I don't even think it's 1% of the total. It's 0.86%. These are your private real estate vehicles that are seeking to generate a little bit more return than core, but they're structured like private equity vehicles. And then 5% to commodities. If we go down the page and look at the simulated statistics, there's two sections there, intermediate and long-term. As you may recall and you saw on the prior page, we have intermediate term return and risk assumptions that are based more on current valuations and current yields, and then long-term expectations that are based more on long-term historical. When we run this model to look at the output, any time horizon under 10 years is using the intermediate assumptions, and then when we move out beyond 10 years, it's blending the results of the intermediate and the long-term. So the further out you move in time, and really when we're looking at a pension fund, thinking about a reasonable risk and return and a reasonable probability of achieving in your case, 7.1%, we're leaning more heavily on the long-term assumptions as we move out in time. That said, we want to be cognizant and aware of where we are today from a starting point and what things are going to look like. So that 10-year median for your target portfolio of 6.43%, that's the 50th percentile probability return over the next 10 years for that mix of assets for your current policy target. And if we look at 20 years, you move out, and the long-term assumptions are coming more into play at 7.45 is the 50th percentile. So the asset allocation appropriate for an investor that needs a 7.1% return. That's what your target return is. Mix 1 and Mix 2, in eliminating that commodities allocation to see what the impact of that would be, what we're trying to do is improve the efficiency, the risk-adjusted return, not give up return, but hopefully lower risk as well. And in both cases, it does both. It increases removing the commodities because of where that return assumption has come down to. It improves return, and it also lowers risk as measured by standard deviation because it's such a volatile asset class. So in Mix 1, we just took that 5% and put it in fixed income. And you can see the return looking at that 20-year median line goes from 7.45 to 7.7, and the standard deviation drops from 10.48 to 10.12. So standard deviation is a measure of risk or volatility. The other risk metric that we're showing here is a first percentile return. Think of this as this is any 1 year, not over a time horizon. So this is like worst case scenario in any given year. Currently, the first percentile return is negative 19.6, meaning in any 1 year, there's a 1% probability that the portfolio could be down 19.6%. This removing commodities actually improves that a little bit. Either way, you're not going to be happy if we have that scenario. That's a 2008 scenario. Actually, 2008 was a little bit worse than a 1% probability. It was about a 0.5% probability. But we're wanting to see, does that impact that mix? Mix 2, again, removes the commodities but doesn't change the broad asset allocation between equity, fixed income, and real assets. And we're just reallocating to core real estate, bumping that up to 10, and opportunistic real estate, bumping that up to 5. So our recommendation would be to move your policy mix to Mix 2. So really, what we're presenting today is a recommendation to change your policy targets, not necessarily to terminate the manager at this time, because we'll need to put a plan together as to that's efficient as to how that money can move. Because right now, if you were to adopt our recommendation, which is mix 2, you couldn't put money in opportunistic real estate. It doesn't. You can't automatically just add money there. These are private, closed-end funds that call down capital over time. You currently have in that space TA and Singular Guff, Distressed Real Estate Opportunities Fund. You've got about $4.5 million currently invested, and there's $5.8 million in unfunded commitments that will be called over time. That is an area where we would, regardless, we need to add to that. So that's the recommendation. Again, at this point, limited to just adjusting policy targets.
Does anybody have any questions regarding that?
What would the time frame be estimated if we adopted that?
Would the termination of the manager, we'd probably do by the end of the year. Where those funds go, it will go in accordance with the bans and other asset classes, because we know we're not going to be at 5% in opportunistic real estate. But we'd want to come back to you with the other piece of that is the core real estate would go up some, and even the your core real estate fund, Morgan Stanley, there may be a entry queue to get in, where if you say you're going to add $20 million, it may take several quarters to do that. And so we just want to balance that up with a thoughtful plan as to how to do that. But we would attempt to do it by the end of the year.
So, Jason, are you recommending
Recommending that
mixes
you
over
adopt mix 2 as your policy target allocation.
mix 2? Okay. Now, the chair will entertain a motion. Have a motion and a second on item 9A. All in favor? Aye. All opposed? Motion carries. Item 10 is investment consultant report.
Okay. Well, you have a copy of the ASAP with all my chicken scratch on it. I apologize, our delivery from FedEx didn't make it here this morning, so you see the in-depth notes that I've added to my version as we look at it. So I wasn't sure what the order was today, but you'll see on here the first page, the current allocation and where you've been a little bit overweight to U.S. equities, U.S. large cap, which has been beneficial, slight overweight in fixed income, which has actually been beneficial over the last year, and core plus, the biggest overweight within fixed income. And that has been a big benefit as well. In my chicken scratch at the top, you don't have to read it. I'll tell you what it says and what I was trying to communicate here. As we look at the last year, I mean, we continue to hear about the issues with the trade war impacting markets, concerns about low and slow global growth, low interest rates, negative interest rates in Europe, and declining rates in the U.S., perhaps not as fast as some folks would like them to be declining, particularly the Fed funds rate. But as we've seen interest rates in the U.S. come down, the best performing asset class as a result of that has been U.S. investment grade bonds, and in particular treasuries. We've talked about this quite a bit. Your portfolio as a long-term investor, we're more concerned about long-term yields, not necessarily taking advantage of rates coming down and over concern of a slowing global economy. But on a one-year basis through yesterday, the Barclays Ag, or the Bloomberg Barclays Ag, is up 9.67% on a trailing one-year basis. The S&P is up 6% on a trailing one-year basis. So U.S. bonds, investment-grade bonds, have outperformed stocks by over 3%, almost 3.5% on a one-year basis. Within your portfolio, while I mentioned those two managers that have done really well, WAMCO in particular, your Core Plus manager, they've taken down a lot of what is considered the plus exposure, so they're more core right now. So they have treasuries and agency-backed mortgages, very little corporate or high yield or non-U.S. debt. And that strategy is actually up over 11.5% on a one-year basis. So you're getting a benefit there. Your bond index fund, the SSGA index fund, it's up in line with the market. Actually, on a one-year basis, through the end of August, up 10%, a little over 10%. But your overall fixed income is lagging the Bloomberg Barclays aggregate, which we use in the policy index to measure your overall fixed income, because the construction of your overall fixed income is really designed to mitigate against rising interest rates and a low yield environment. You have exposure to strategies through PAMCO and Brandywine and WAMCO on a more dynamic basis that are intended to try to take advantage of other return drivers within fixed income. And so very little U.S. interest rate exposure. So when we roll up all of your fixed income, and if you look at page 2, on a one-year basis, the fixed income composite, while with the exception of private equity, is your best performing asset class, up 7.4%. That's trailing the Bloomberg U.S. aggregate by about 2.5%, a little more than 2.5%, because you don't have as much rate exposure there. So overall, on a one-year basis through the end of August, the portfolio up 3.1 gross, 2.6 net, and your policy index up 3.16. Most of that dispersion is the fixed income there. The other thing I want to point out, and this will be more evident as we look at longer term, if we go to the 10-year numbers. So this policy index, the policy index is intended to be indicative of what you would get if you invested passively in the markets. That said, it's not perfect, and there's a couple of, because you're not implementing exactly like that policy index. The hardest parts to measure that attribution is long-short equity and private equity, and then absolute return as well, because they're doing different things. They're not trying to look like any benchmark, but we're representing what they're doing by, in your policy index, by a long-only index. The biggest component of your policy index is the S&P 500. It's 35% of your policy index is the S&P 500. And that represents the 20% target to U.S. large cap, which should be the S&P 500. It also represents the 10% to long-short equity and 5% to private equity. So we know your long-short equity is global, so is the private equity. And we also know that they're not going to track the S&P 500. But over time, we want to get equity-like returns with less risk from the long-short and a premium return from private equity. The long-short equity, just to be that global component, if we look at the long-short composite on page 2, you'll note we are comparing the long-short composite to the ACWI and then to a hedge fund index, equity-oriented hedge fund index. On a 10-year basis, the ACWI, which is a global stock benchmark, it's U.S. and non-U.S., it's the entire or all-country world index, is up 9%. Where the S&P 500, if you look up, is up 13.45%. So you've got a huge dispersion between U.S. and non-U.S. stocks. That ACWI benchmark includes U.S. It's about 50% U.S. and 50% non-U.S. So having that 50% non-U.S., you see, brings that down quite a bit. The point is that a big part of the dispersion is simply that long-short equity is global, not just U.S. large cap. It's got a lot of other things. So that on a 10-year basis, that differential there is about 5%. The hedge component of it, because we've talked a lot about just being hedged has hurt, hasn't been that full 10%, the difference between the HFRI strategic and the S&P. If we use the ACWI, which I'm looking at, and I had some our performance people just run this for me yesterday just to see the difference. If we swapped out the ACWI for 10% of the S&P exposure in the policy index, that's going to bring down the total policy index return by about 40 basis points over all time periods, which is probably a little bit more reflective. It doesn't bring your return down. It's just what we're comparing against, which is probably a little bit better, apples to apples. So on a 10-year basis, your policy index is 8.59. If we took 10% of the S&P exposure and replaced it with ACWI, that would bring it down to 8.21. So that's a little bit better reflection. You might say, well, why use the ACWI and not the HFRI? Well, we don't want to use the hedge fund indices in the policy index because we lose the tracking of what the risk reduction that we're getting. We're trying to see, are we getting risk reduction from the long-only markets from the introduction of the hedged component. But I just wanted to point that out because a lot of times we're looking at this and saying, what's causing all that dispersion? We don't look as good. Well, you're not exactly, the policy index doesn't precisely replicate what you're doing across the portfolio, and it's about 30 basis points from that global exposure over really every time period. So that said, if we look on page 2, again, and just go down the line here, on a 10-year basis, you see your large cap has outperformed the S&P by about 30 basis points over 10 years. Your small cap has outperformed by about 1.3% over 10 years. The long-short equity underperformed in a period where the markets are up. We would expect it to underperform the long-only index, but outperform the hedge fund index. Private equity, while it's a small allocation, you have gotten a pretty good premium return. It's kept up with large cap stocks over that time period, and certainly more recently in the 1-year period, you have a 9.5% return from your private equity portfolio, which is from an asset, it's your best performing strategy, outperforming fixed income over that period. And again, it's not correlated to the long-only markets because of the timing lag. International developed equity, which is Lazard and Harding Loevner, in a 10-year period where non-U.S. has really underperformed U.S., you've gotten some excess return there, about 11 basis points over that 10 years. It's more pronounced over 3 and 5 years. Emerging markets, you've had since 2012 dedicated emerging markets. So that very far right column is the since inception of June of 2012. Your emerging market managers have added about 1.3% relative to the emerging market benchmark. That said, over that time period, again, U.S. stocks have done better. So it's been having the EM relative to U.S. has hurt a little bit. But more recently, your EM managers have done very well. Wasatch, who mentioned, they lowered their fee by 35 basis points, and I think you got that. Or not 35 basis, 15 basis points in the strategy that you're in. But that strategy has done very well, and on a 1-year basis, your emerging markets, which is the combination of Wasatch and Wells Berkeley Street, is positive when the benchmark is down about 4%. touched on the fixed income, but longer term, 10 years, your fixed income has added almost 80 basis points relative to the ag, and that's really been from those other areas that we talked about, having less interest rate sensitivity, more credit exposure, more non-U.S. exposure. So through the strategies that right now are kind of bringing you down, those you've benefited from those over the 10-year time horizon. And then real assets, right now, 1 year, most of that is coming from the Morgan Stanley strategy, as well as the private real estate. Your private real estate, while it's a pretty small piece, it has delivered good returns over the last year. The returns for the opportunistic real estate, those two funds combined, are up 17.6%, and the Morgan Stanley strategy up 8.4%. So I know I typically don't go down in a lot of detail, but I think it's important to look at just how well each of your asset classes is doing relative to its targets. And then your overall, really it's been a good 10-year period, and you have outperformed your benchmarks, and most importantly, your required rate of return. It's been a good period for that. But as we look forward, as we're looking at asset allocation, I think it's important to note what our asset allocation is showing for the next 10 years is much more muted returns. So, you're to be commended relative to peers for how aggressive you've been in lowering that return assumption. I think you're really taking into account reality. That's a hard decision for a lot of boards to make and cities to make, because that it has an impact on funded status and contribution rate. But I think it really reflects reality when what we're looking at here, even the somewhere between 6.5 and 6.7 over the next 10 years is the median. That's not saying you can't be above that, but that's the 50th percentile. So much more muted returns going forward because we've come off a pretty strong 10-year period. I don't have an answer to that question. The Purdue Pharma, I don't, Diana. I can look into that and see what kind of exposure you have there. I'll find that out. Get back to you.
Any other questions for Jason? Hearing none, item number 11 is comments from board, staff, and citizens. Hope to see as many of you as possible up in Tulsa. 2 weeks? Yeah, 2 weeks.
I was going to let you know we have 3 cases that may be brought before for securities litigation that we have been asked to be lead plaintiffs. While and I are still reviewing the actual losses that we may have occurred to see if it affects with our policy and see what other circumstances are involving those, but we'll be presenting other information in the October meeting.
Thanks, Renee. Okay. Hearing no comments, we are adjourned at 10:31. Thank you.